There might be some bad news for the stock market here, so let's go over it and see what's happening. And as always, we're going to use our research from MacroOps, which is our global macro research and consulting firm. So one of the components of our trend fragility indicator is aggregate US fund flows, which means, where's the money going? That's always important to know when you're evaluating the stock market. So these flows climbed into the 99th percentile last week. And the last time fund flows were anywhere near these levels was February 2020 and January 2018. So you can see in this chart right here, the last time it happened, the stock market took quite a dip. Now, if you're thinking, hey, a bunch of money coming into the market is a good thing, that's true in a sense, but it's also an indicator of sentiment. And we know that when sentiment gets too crazy, that's actually bad for a bull market. Now, typically this type of piling into US stocks is accompanied by other strong indicators of sentiment, but in this case, not so much. If you look at the AAII bull bear sentiment, it fell to the lowest level in 12 months. So that's the fun part about markets. When you're looking at different indicators, sometimes they don't fit together because no one single indicator is going to tell you exactly where the market is moving. So you always got to use different data points and put them together to see a picture of what's going on. And in our case, in this current market environment, as you'll see in a few minutes because we're going to talk about it, things are pretty murky in the sense that the internals of the market are all messed up. Diverging signals everywhere, and sometimes this happens. Market isn't always going to be super clear all the time. So here we go. There's a lot of noise in these markets between the internals, divergences, and funky economic data. There's evidence to support whatever bias you got. And that's why it's always important to go back to the best indicator there is, which is price. Because guess what? You could look at every single indicator under the sun, but the only thing that matters at the end of the day is whether stocks are moving higher or lower, which is why our Fallible system is primarily based off price. It's the king indicator. So I guess what I said before is not exactly true. If you were to look at just one indicator to make all your decisions, it would be price. So pulling out a bit, we can see that the S&P is in a strong uptrend and it's put in 7 consecutive monthly bull bars. That's a very strong reading. And it's a very rare reading. It's only happened 6 other times in history. And only once has it put in 9 bull bars and never 10. So when we use our back tester on this data, we see a bullish long-term bias, but with high odds of weakness over the next few months. So there's a couple of things to take away from this. First, that momentum is one of the most dependable market factors, which is, again, why we use it in the Fallible system. And 7 bull bars means there's a lot of buying strength behind this trend, which suggests that we got much further to go. The second thing to understand is that the forces of mean reversion and profit taking will eventually, and likely soon within the next 2 months, lead to a 1 to 3 month 10 to 20% correction. And this would just be a normal healthy pullback within the larger bull trend. And again, this is completely natural because markets will always grow through periods of trending and then mean reversion. Markets never just go straight up. That's not how it works. But if we get this 1 to 2 month pullback, the bull market will still be intact. So you always got to remember when you're investing, what time frame does your strategy work on? Weekly, monthly, yearly? Depending on your strategy, you will react to this information differently. Now, more recently, the S&P put 2 consecutive bear bars in with a backdrop of euphoric fund flows. Remember what we said about sentiment, right? Any euphoria is actually bad for the market. It means it's winding down. So we have to be ready for more potential downside over the short term. But what's interesting is the divergence in credit. And this is what we're talking about. A lot of divergences in this market. So the higher yield credit has been trending up while the S&P has gone down. And positive divergences like these typically lead to a strong upside follow through in stocks. So maybe we get a reversal in the market pretty soon here. So there's a possibility that the correction gets pushed off a bit. So we use something called a trifecta lens score, which measures various breadth, liquidity, and sentiment indicators. And right now it is neutral. So you don't typically see a neutral reading when you're in a blow off top, meaning once again, this thing might be extended. We've also seen improving economic data relative to expectations, which has typically been a good backdrop for risk assets like stocks. So the S&P saw positive returns 15 out of 18 times over a following 2-month period with average gains of 4.7%. So another stat in favor of the bulls. And this should be helped further along by what looks like a peak in the Delta wave here in the US. Thank God. Who's not tired of hearing about this? Nobody, because everybody's tired. Also, another positive long-term sign is that we're seeing an increasing percentage of country indices turning back into uptrends. So different countries turning back to bulls. Going back into the micro for specific stocks, we are really bullish semiconductors. Look at this. We're creating 2.5 quintillion bytes of data every day, and global data is doubling every 2 to 3 years. So what processes all that data? Well, semiconductor chips. We are in a longer term demand super cycle where capacity is constrained. You can see right here the 5G capacity limit will be reached by 2028. But actually, because we have new applications like virtual reality, holograms, all this autonomous vehicle stuff, stuff, could it actually happen sooner? And what fuels all this? Again, semiconductors. Another area where we're super bullish is in energy, especially in oil. So between the capex cycle, ill-advised government policies, and ESG incentives starving the space of capital, oil is teed up for a big cyclical bull market. It's been years in the making and it's just getting started. And the short-term technicals in this market are very supportive. So there's a number of names that we like in this space. One of them is Diamondback Energy. FANG has a nice chart, and they recently announced a massive buyback and debt reduction program. So that's always good fundamental news. Definitely add this one to your watch list. And here's a good quote from Nassim Taleb that kind of goes with this theme of all these divergences and whatnot in the market. So the mind can be a wonderful tool for self-delusion. It was not designed to deal with complexity and nonlinear uncertainties, which is exactly what the market is. Counter to the common discourse, more information means more delusions. Our detection of false patterns is growing faster and faster as a side effect of modernity and the information age. There is this mismatch between the messy randomness of the information-rich current world with complex interactions and our intuitions of events derived in a simpler ancestral habitat. Our mental architecture is at an increased mismatch with the world in which we live. Yes, things are complicated and we can't comprehend them, which is why, yes, we go over all this data, but I really like what Alex said, that you can always trust price. That simplifies everything into one indicator, up or down. And that's why it's the primary factor in our strategy, which if you haven't learned about, you should right now. We got a free training that I'll put a link to in this video and down below in the description and comments. Check it out. It teaches you exactly how we use price to be consistently profitable year after year with, of course, solid risk management. It's important. You should check it out. As I already said, here's a link to it right here. Click on it and I will see you in that training.